Today, we are jumping straight into the dividend growth portfolio and looking at one of the largest target weightings in the portfolio. In fact, it's tied for number 2, currently at 9% of the dividend growth portfolio. And this is a company that you all know and love, which is JPN, JP Morgan Chase. And it's a company that has done pretty well over the last several months. Over the last 1 month, it's been up 4%. Over the last 3 months, 28%. And a pretty similar performance over the last 6 months. Now, year to date, throughout the first trading weeks, because we're just at the start of January, this company's done good, but I want to talk about where I think this company's going. Because lately, this company has been recovering steadily. Just a couple months ago, it was $100 a share. Today, it trades at a price of around $140. Today, it closed at $139.49 as of January 12th on the time of me filming, and this is a company that has started to recover quite nicely despite this recession. Revenue is nearing all-time highs, and profitability is slacking a little bit, but I think it's going to come back in a big way over this next year or two. However, if we jump in the dividend growth portfolio and we see that it's one of the largest positions, it's one that I'm currently considering lowering my target weighting on. Now, I don't think that this is going to go down dramatically. Don't expect it to go down to 2% or something crazy like that. But I think that there's some other sectors that I'm considering wading into. And so this could possibly be a company that I consider transitioning money from this position into another one. We're going to talk in this video all things JP Morgan, just some basic overview of the company, where they're at, and obviously what other investments we could potentially be looking at in the overall valuation of JP Morgan and why I consider investing in them. And overall, we're going to talk about economic cycles and how this could affect JP Morgan as well. It's going to be a fun one. Without further ado, let's go ahead and get started with JP Morgan, and let's take a look at the company head on by go ahead and starting with its fundamental quantitative numbers. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, welcome back, and you can see in the most recent quarter it produced $32.72 billion in revenue, and that is about a 10% growth rate year over year, which is pretty good considering it's JP Morgan, because this is a company that traditionally does not grow very fast. On a 10-year compounded rate, they only grow revenue at about 2%. Over the last 5 years, it's been a little better at about 5%, but generally speaking, this is a low, slow-growing compounder, because JP Morgan is so big, they're the largest bank in the world, currently sitting at a $400 billion market cap. Now, this is a company that has long-term been buying back shares on a consistent basis like many of the big banks ever since the financial crisis. Right around 2011 right here when they started buying back, they had 4 billion shares outstanding, and it's consistently gone down quarter over quarter, and they're now under 3 billion, which is a pretty big downturn considering this is a big financials company. And if you see, that represents about a 1.3% downturn year over year, and this is a company that still has a lot of cash on the balance sheet. Now, this is going to look a little bit different than normal because their financials, so their balance sheets don't look the same, but they have about $876 billion in cash right now, but that also includes customers' deposits. Of course, that's not just their own money. Now, this is a company that has been raising its dividend pretty consistently ever since the financial crisis. When they initially raised it back in 2012, it was about 25 to 30 cents, and it's increased since then to about $1 per share. Now, JP Morgan right now sits at a dividend yield of 3%, and one of the big reasons why I wanted to invest in it back then, and I started increasing it, was because we were increasing our shares around the $100 range. Now, right now it trades at $140, which means it's increased a lot, which of course means its dividend yield has gone down, and the most recent quarter came in pretty strong. If you want to pause the video right here, you can see an overview of how the company's doing, but generally speaking, all its long-term financial metrics are up. Now, out of my portfolio, I'm currently investing in many different companies that are growing very fast. This is my portfolio balance as of the time of me filming, 44,000 and change, and this is my performance year to date as of January 11th versus the major index indexes. And of course, if you want to see some of my other highlights, such as my portfolio balance over time since starting YouTube, my holdings tab, as you can see right here, and then my performance in 2022, this is what all three of those look like. However, if you look at JP Morgan, there's a lot to be excited about. However, one of the big catalysts that I'm not excited about are these two tabs we're going to go over. The first one is valuation. Now, JP Morgan, we're on Seeking Alpha right here, and one of the major ways to value a big bank company is to look at its price to book. The price to book is about a 1.6. Now, as you know, if you know anything about financials, a 1.6 is not cheap. So as an example, let's go ahead and look at the sector median, this column right here. So this number, 1.28, is where the average in the sector is at. So think your Bank of America's, think your Wells Fargo, think of all these big banks. The average is around a 1.28. JP Morgan is a 1.6, which is 25% higher on average than the average in the market, and JP Morgan's long-term average, it's currently slightly ahead of that as well. So the company, not only on a sector basis, but also on an individual basis, is trading higher than it normally does in terms of valuation. Furthermore, something I'll mention is the economic cycle. Now, right now, we're in the bottom right. This little nasty one down here that says recession, this is when the ones to watch are your big utilities, consumer staples, healthcare. And we're leading in, we're kind of the middle of where we are between recession and recovery. We're going down, and I think we're looking towards the yellow, bottom left, recovery. And the sectors you want to watch in that part of their economic cycle is industrials, materials, real estate. These are the good ones to watch during that time period, okay? Now that's great, but what about moving forward? Afterwards, we have expansion, which is the big economic boom, when jobs are coming back, when money's coming back into the market, and that's when you want to look at consumer discretionary. Technology, which is very heavily what I'm invested into, moving into 2023, 2024, hopefully what I think will come throughout the next year or so. And then afterwards, we get to the peak, the green at the top right, and that's when financials really start to boom and really start to peak out. And that is at the complete opposite of where we're at right now. That's so far around the economic cycle that we're not even close to that. We're just now talking about interest rates potentially coming down, and I don't think this is going to be very good for JP Morgan. And I don't think that this is going to be very good for JP Morgan. The company is already a slow grower, and I don't expect it to grow much faster considering the circumstances given where we're at right now. The valuation is not very cheap, and the dividend yield is not nearly as good as it used to be. However, it's still a great, wonderful defensive company, which is what we look for dividend growth stocks. However, when I look at this list at the other 17 companies in here, there are many others that I find interesting and I want to invest in. So JP Morgan, when I think about this company, it's not the worst company ever to be buying, honestly. There are much worse companies to put your money in, even with dividend growth company. But overall, considering the company has went up quite significantly over the last couple of months, the dividend yield is lower, the valuation's higher, and I honestly think that we could see a little bit of a cooling off period because the economic cycle is still so far away for a company of this sector typically to boom. I think it's very likely that we could see JP Morgan kind of flatten out or even downtrend, and in the meantime, I could be investing in one of these other companies that, in my opinion, think offer a lot more value. Thank you guys so much for watching. Check out MooMoo if you haven't already. Get signed up and get 20 free stocks with them today, and you'd help support me in the channel. Thank you guys so much for watching, and I'll catch you all next time.